Now, I talked about a global recession. People go, well, isn't that like your liquidity crisis? No. A recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. On October 19th, 1987, we had a financial panic. The Dow Jones Industrial Average dropped 22% in one day, but there was no recession. In 1998, a Russian long-term capital management crisis, and I had a front row seat on that when I negotiated the rescue of long-term capital management. We were within hours of shutting down every market in the world, just hours away. The deal got done. That didn't happen, but it was very close, dangerously close to happening, more than people will realize. We had finance ministries and U.S. Treasury and the Federal Reserve and every lawyer in New York working on that one. But I was, kind of leading that and saw how bad that could get. But there was no recession. There was no recession in the United States. The NASDAQ was on its way to record highs. The economy was expanding. In 2000, we had a recession, but did not have a financial panic. NASDAQ dropped 80%, but there wasn't a lot of leverage involved in that, and it didn't spread to banks and brokers and other institutions. In 2008, we had both. In 2008, the economic recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time. Now, why do I say that? There's a global dollar shortage. Now you have to look behind the curtain, not to get too in the weeds, but you got to go behind the curtain of the international monetary system and understand what's there. The international monetary system is not driven by a central bank. Sorry, Reserve Bank. Sorry, Fed. You're not in charge. The parties who are in charge are the euro dollar banks. When the Fed prints money, they printed $9 trillion, but they do it by buying bonds from the banks, and the banks take the money and give it back to the Fed. The money doesn't go anywhere, it just sits on the Fed balance sheet. The money that can drive an economy comes from lending and basically checking accounts, where a bank will make you a loan, put the money in your checking account, and you go spend it. That can get some economic growth. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less. You come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you were based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar, it's real money, it's nice to make the money. But if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. But the Eurodollar market are the major banks transacting primarily in dollars, but it can be foreign currencies from time to time, outside of any regulatory scheme, outside of anything the Fed sees, outside of what the Bank of England sees, etc. It's there, it's big, but it's amazing how little central banks understand about the Eurodollar system. Now, here's the point. There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, there are $1 quadrillion of derivatives, and they have to be supported with collateral. And the collateral is not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. But this is in the data, again, not anything that we've invented. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge. It's by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, if you're Barclays, well, actually even the U.S. bank, Citi or whatever, but if you're Barclays or Deutsche Bank or others, and you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold, and I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So there's just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. It lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But, when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and, for publicity, because I could care less. But if you just took the average, there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025. And at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. That's why the U.S. dollar is so strong. People go, wait a second. The U.S. has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets. What's driving the demand for dollars is the need to get dollars to buy dollar-denominated collateral, specifically treasury bills, to post as collateral to support the $1 quadrillion of derivatives. And that's going to persist until the system crashes, which it's in the process of doing. So that explains the dollar shortage, by the way. It's why you see China's reserves are going down, Japan's reserves are going down, India's reserves are going down. Switzerland recently did a dollar swap with the Federal Reserve. Why would Switzerland need a dollar swap? Not enough dollars. So this is going on all over the world. People go, oh, they're dumping U.S. treasuries. They don't like them. No, they're desperate for U.S. treasuries, but they have to use their dollars to prop up their local currencies because of this dollar shortage I described, because they can't get them from their banks or the Fed or any other source. And by the way, this shows up in the U.S. Treasury curve is inverted between 1 year and 10 years.